So good morning, everybody. I'm hoping you can all hear me. My name is Dan Datar, and Aruna Batra asked me to join in today to share a little bit of knowledge on my experience in the mortgage side of the business, specifically in the area of comparing the advantages of homeownership versus renting. So that's what I would like to do. I left about a half hour for this presentation, and then I have at least an hour available. If there are questions that people would like to ask, then by all means ask them. But let's try to keep the questions to the end if possible, unless I lose you. Stop me and ask questions if it gets confusing here. Okay, so this shouldn't be too complicated. I'm going to attempt to share my screen with everybody right now. Okay, so Aruna, can you answer? Can you see me? Or not me,
Yeah.
but that's
yeah, I can see it. I can see the screen also.
Yes.
Okay, I'm going to change this view just a little bit here. Okay, so again, my name is Dan Datar, and my contact information is right there in case you would like to follow up with me at a later time with regard to questions, etc. Today, we're talking about renting versus owning. And so I just plugged in a simple scenario. It's very easy in this program to adjust it to match whatever your particular situation is. So by all means, if I can help you to create clarity afterwards by adjusting this to your particular situation, then I'm happy to do that for you. So in this scenario here, what we are comparing is paying rent at $3,280 a month. Let me make it a little bit bigger here. Hang on one second here. Okay, so can you see that? $3,280 per month in rent. And what that is a breakdown of $3,250 for rent and $30 a month for renter's insurance. And then I made a few assumptions, and we looked at a 60-month period to do a comparison. And I assumed that your rent is going to go up by 4% per year. I don't know if that's accurate or not. I can easily adjust it if it need be. It might be more, it might be less. I'm not sure. But let me just go down this column real quick. So $3,280 is your monthly rent, and the tax benefit that you enjoy for being a renter of $640 a month assumes two people filing jointly together and declaring the standard deduction when you file your tax return. So that's $2,000, sorry, $20,000 per year. I think it's $20,400 this year, but it was $20,000 for two people last year. And we have to make some assumptions here. So I assumed that the income is $185,000 per year. And if that was the case, there would be a tax bracket in California of approximately 32%, meaning that 68% of each dollar that you make, you bring home, and 32% of it goes to taxes. And if that is the case, if you take $20,000, your standard deduction, and calculate how much savings you would have if you deduct that $20,000 from your taxable income, it works out to be $640 a month, or a little over $7,000 per year. That's 32% of 20. Okay. So if you subtract your tax benefit from having no deductions other than your standard deduction, your monthly net after-tax rental expense to start is $2,640. Okay. Now, if we move that over and compare that with buying a home, in this scenario, we're assuming a $1.1 million purchase price and a 20% down payment, which would be $220,000. And your loan amount would be $880,000. If we calculate a monthly payment based on a 30-year term and an interest rate of 3%, your monthly principal and interest plus taxes and insurance would be $4,925.95. Okay. From that, you would enjoy a monthly tax benefit of $895. And the way that we get that one, where we get that $895 is we know that you can deduct your property taxes, and we know that you can deduct interest on the first $750,000 in borrowed funds. So if you take $750,000 and calculate how much interest would be paid on that at an interest rate of 3% per year, and then add in how much property taxes you would pay, and then take 32% of that and then divide that by 12. I did that pretty quickly, but please ask me if you have questions. Your monthly tax benefit would be $895. Then on top of the tax benefit is also part of this $4,925 is a principal portion of your monthly payment. So the principal that you would pay each month is $1,510. So if you add 1,510 to 895, you get $2,520. And that is what if you subtract 1,510 and 895 from your monthly payment, you have a net payment of $2,520 per month. Now that usually loses a few people. So I want to stop here and see if anybody has any questions on how we got that 2,520 compared to 2,640. How is it that you're paying $5,000 a month and it's still cheaper than paying $3,280 per month? Anybody have a question on that, or is that crystal clear? If you have a question, just unmute yourself and ask me a question.
No, you may go ahead. We are clear, I think.
Okay, good. That means I'm doing a good job, right?
Yes.
Just kidding. Okay, so in this display here is more info tab, and that is really breaking down where I got the numbers that I just explained to you. On a 30-year fixed rate loan at 1.1 million on an $880,000 loan, the principal and interest portion of the payment is $3,710. The property tax is $1,145, and that assumes, and it's a good rule of thumb, that your tax rate is 1.25%. Now it proves to be a little bit more than that in most of the cities in Santa Clara County. And one of the reasons why is many of the areas in Santa Clara County now have the garbage bill being reflected as part of your property tax bill. So that adds a few $100s to property taxes on an annual basis. And then there are also typically special assessments and other things going on in your neighborhood that would cause your property taxes to possibly temporarily be more than 1.25%. But the nominal rate and the good rule of thumb in our area is to calculate an estimate of property taxes at 1.25% of the purchase price. So that's what we have here. And that's where we get this $1,145. And then I also assumed that hazard insurance would be about $70 per month. And that $70 per month is typically, I mean, that's an annual premium of $840, which is pretty close to what most people would pay for a hazard insurance policy for a single family residence in this price range. I want to be clear. Oops, battery low. Guess I better plug in the battery. Hang on one second. The monthly payment of $4,925, that is principal, interest, taxes, and insurance. But it's your choice. You do not need to pay taxes and insurance as part of your monthly payment when you have a mortgage, unless you have a very small down payment. So you could choose to pay $37.10, the principal and interest portion, on a monthly basis, but make sure that you set aside the taxes and insurance because you will have to pay those. And these numbers are based on a 12-month, or the annual cost divided by 12. Okay. As far as closing costs are concerned, in Santa Clara County, there are typical norms of who pays what. And in Santa Clara County, the seller typically pays the lion's share of the closing costs. The only portion that the buyer has to pay is the title insurance that covers the lender and some garbage fees, I think is an accurate term. Things like courier fees and recording fees and notary fees and loan tie-in fees. But the total is very small compared to the amount that the seller pays. The seller pays the escrow fee, and the seller pays the owner's title insurance, and the seller pays the county transfer tax. And when you add those up, they're significant to the seller, but the buyer doesn't have to pay them at all. So I've estimated that the closing costs in this scenario are low because it's in Santa Clara County. It's making that assumption. Now, where those assumptions do not hold true is if you are buying a brand new home from a developer. They typically have a different contract that does not follow the norms in the county, and you end up paying a much higher number as far as on the closing costs are concerned. Also, on the closing costs issue or subject, there are two types of costs that are applicable at the close of escrow. There are those costs that are one-time costs that are there because you're buying a house and you're getting a loan. Those we refer to as non-recurring costs. And those are the costs that are mostly paid for by the seller that I was just talking about. There are other amounts that are due at the close that are recurring expenses, and recurring expenses are property taxes, insurance on your home, as well as interest on your loan during the month that we're closing. So depending on when we're actually closing, those amounts will apply, but they'll vary quite a bit depending on what month of the year that we're closing and then what day of the month that we're closing. So if you are establishing an account to pay your property taxes as part of your monthly payment, we need to collect some funds up front and put those funds in your name in an account that builds up to assure that there's enough property taxes and insurance in an account so that we can pay them for you when they come due. And on this closing cost worksheet that I have here, that's this $6,779. Those are prepaid expenses for taxes and insurance. Okay. Does anybody have a question?
I think someone had a question about who pays the county tax.
Oh, okay, moving right along. So this net monthly payments is what we talked about before. The $2,640 is how it starts out, and the net cost per month on the renting, and the $2,520 is after the tax benefit and the principal pay down. So we look at this over a 60 month period. Just from a tax benefit standpoint, you would have $52,347 in tax benefits over a 5-year period versus your standard deduction of 38,000. See, I just got a question with regard to the county transfer tax. On a purchase transaction in, I think, all counties in California, the county charges a transfer tax, and that is 1.1% of the, or it's actually $1.10 per $1,000 that changes hands. $1.10 per every $1,000 that changes hands. And that is always through every county in the whole state paid for by the seller. In many counties, in many cities within the county, there is also a city transfer tax. The city transfer tax in San Jose, for example, is $3.30 per thousand. So that can add up. It's $3,300 on $1 million house. And that is split evenly between the buyer and seller in normal circumstances. So, you know, on $1 million house, it would be $1.65 per thousand that the buyer has to pay. So that'd be $1,650 on top of the other closing costs. I plugged in the code of 95035 in this scenario, which is Milpitas, and the city of Milpitas does not have a city transfer tax. So if you really want to avoid the city transfer tax, buy Milpitas. No, I'm just kidding. You can buy in lots of places, but the city of San Jose and the city of Mountain View are the two cities in Santa Clara County that have transfer taxes. Okay.
Sorry, like my question was, so you, the seller has to pay that, and it's a one-time payment, and he completes it after the transaction is done. Is it something like that?
You're talking about the county transfer tax?
Mm-hmm.
Yeah, that's a one-time. It's only paid when the property is sold and the ownership changes. That should not be confused with property assessments, the regular property taxes that are paid on an annual basis. Those are the 1.25% that I mentioned before, and those will always be paid for as long as you own it.
Irrespective of the property, if it is a town home or it is a single family home, the seller is obliged to pay that.
The county transfer tax, I believe it's certainly in Santa Clara County, and I believe for every county in the whole state, it is normally paid for by the seller. However, if it's I mean, closing costs are negotiable. So you could have a normal contract and then an addendum to the contract or some terms written into the contract for the buyer to pay something instead of the seller. Anything can be written in a contract as long as it's agreed to by the buyer and seller, it will happen. But I'm just speaking of the norms that are applied in especially Santa Clara County. The seller will pay it. Okay.
Yeah, thank you.
You bet. Okay, so I wanted to go down to this net worth section. So this is, I looked at a longer term period of 15 years. And I'm going to open up this screen that breaks it down a little bit better. So over a 15-year period, if we look at the net cost to the borrower or the renter, it's almost identical. It's $886 in payments if you're an owner, and $846 or $846,000 if you are a tenant. The tax benefit is, you know, it's substantially more if you're an owner than it is if you're a tenant. But if you factor in the fact that you are paying a mortgage off and gaining ownership of a property, over that 15-year period, you would have paid your mortgage down $342,000, which of course, if you're renting, you don't have any principal to pay down. You're getting nothing for it, right? Then on top of that, if you are making the landlord's mortgage payment for them, your benefit as an owner is zero. Whereas over a 15-year period, if we assume a 4% appreciation, your home is going to be worth $1,981,000 at the end of 15 years, assuming an annual appreciation rate of 4%. And your balance of your loan at that point in time would have gone down to $537,000. And so your equity in your house at that time would be $1,443,000. And that's just by using the amazing function of compounding interest, where your house is going up in value, you're paying your mortgage down, you're taking a tax benefit, and your debt is going down compared to rental expenses, which are going up. I think that we can all agree that it's very rare that you have an environment where rental payments are going down, unless you live in Detroit, Michigan right now. But here, rents go up. Okay. So that is, in a nutshell, I'm probably a little bit ahead of schedule here, but that is, in a nutshell, the benefits of buying a home versus renting one. And there's interesting, it's been a while since I've done a rent versus buy scenario. And it's kind of unique right now because the tax benefit is not that substantial compared to renting. And that's for two reasons. The first reason is that the IRS has changed the rules on interest deduction, and we can't write off the interest that we pay in excess of $750,000 on a purchase transaction. So that's minimized it a little bit because our loan amount's $880,000, which means we're not enjoying a tax benefit between $750 and $880 on our loan amount. But the much more significant factor with regard to the tax benefit is the reality that interest rates are so low right now that you don't pay that much interest over a year. So you don't have that much benefit. But if you compare it to where interest rates were a couple of years ago, and you did say a 4 3/4 rate versus a 3% rate, is a huge, huge, huge benefit for owning now versus owning then in terms of your overall cost to live. So I think that if there is one factor that would be the most encouraging for one to consider purchasing real estate, is that the overall cost of owning real estate is as low as it's been in a long time, just simply because interest rates are so low. Questions? What do you guys think?
So since the interest rates are so low, does it benefit to go 30-year fixed?
So there's a happy medium in there. I mean, there's a lot of people that are choosing to do 15-year fixed rate loans right now, where we're converting a lot of people from 30 to 15 in refinance scenarios. And the overall cost in monthly payments is really huge by cutting the total number of payments all the way down to 15 years from whatever the remaining remaining term of their current loan is. That being said, there's a little bit, you have to conceptualize this a little bit. If you take a big wad of cash and stick it in your freezer, it stays there, but it does not grow. It will not appreciate for you, that wad of cash. And putting cash in the freezer might be safe because you know it's there and nobody's going to steal it because nobody else knows it's there, but it's not giving you any return. And investing in equity is also not giving you any return. It's just like sticking cash in your freezer. However, if you did a longer term loan, say a 30-year loan versus a 15-year loan, and you took the chunk of money that you would have applied toward principal in a 15-year scenario and invest it and get a return on it. So you put together in your monthly budget for investing a 15-year payment, but you take the difference between a 15 and a 30-year payment and you invest it and you get a return on that investment. Then you will have an appreciating asset in your home and an appreciating asset in your investment, and you will grow your net worth way more than paying your house off. And this program that I'm showing you here is capable of calculating the benefit of reinvesting your savings versus paying your principal down.
I have a question.
Okay.
So suppose you are paying the down payment you pay depends that your interest rate will it depend on that. For instance, for a 1 million house, some X is paying 40% and Y is paying only 20%. So is there a possibility that X who's paying 40% down payment will have a decrease, I mean a lesser amount of interest?
Well, certainly the amount of interest that you would pay over the year would be less because you're borrowing less, first of all. But there's a good chance that yes, that you would have a lower interest rate or a lower overall interest expense as a percentage of your loan. And there's a few reasons why. First of all, there are different types of different sources for money, I should say. There are loans that we refer to as conforming loans. And those are the set of loans that conform to a huge list of guidelines that are provided by an entity called Fannie Mae. Fannie Mae is a clearinghouse of mortgage debt. So when banks or mortgage bankers or mortgage brokers put together loan scenarios for buyers, if you borrow $500,000, now a lender has a piece of paper that says you owe $500,000, and they turn around and they sell that $500,000 piece of paper to Fannie Mae, who then gets a whole bunch of different $500,000 loans and puts them together, and they securitize it on Wall Street. And that is what creates the flow of money to lenders so that we can keep lending over and over. So in order to get a loan that is sellable to Fannie Mae, we have this long list of guidelines that we need to conform to, and that's why they're called conforming loans, okay? Conforming loans are the most aggressively priced loans, the best price, best interest rate. And in California, or at least in the Bay Area, there's two sectors of conforming loans. There's the standard conforming loan, which goes up to $510,400, $510,400. And that is the standard conforming loan maximum throughout the whole country. But in our area, because home prices are so expensive, $510,000 loans don't really help that much because most people need to borrow more than that. So they put together, this happened back a little more than a decade ago when the housing market had some challenges. There wasn't enough money available to finance homes in our area or any other area that was higher priced. So Fannie Mae was mandated, and Freddie Mac is a very similar entity to Fannie Mae. We're both mandated by Congress to come up with more money for the higher cost areas. So they made a second sector called super conforming or high balance conforming. And those are not jumbo loans. They're still conforming, but they're in a slightly different category than the standard conforming. And that slight difference is a little bit more interest expense. And then when you get above the maximum high balance conforming amount, which is 765, 400, or maybe 765, 600, I think. When you go above that, then you are in the true non-conforming arena, otherwise known as jumbo loans. And so in this scenario that I have on the worksheet today, this is assuming an $880,000 loan, which is a jumbo. So to answer your question, where you asked if you put bigger down payment down, will you get a better rate? Well, you will if you go from jumbo to conforming, for sure. Your rate will be better. And then you'll get an even better rate if you get to standard conforming. So those, hope that answers your question. Even if you stayed in the jumbo, if you were putting down 30% versus 20%, and both scenarios were in the jumbo arena, you would likely get a slightly better rate with the 30% down. Questions, comments? That's it.
Any more questions, anyone?
ಇದೆಲ್ಲ ಶ್ರೀನಿವಾಸ್ ಫಸ್ಟ್ ಇಲ್ಲು ರೆಂಟ್ ಹೊಡಿತೀಗ ಆರೊಂದು
I guess that's it.
Hey, I have a quick question.
Okay.
Yeah, so when we are going for buying a house, right? So apart from the loan amount what we are paying, what other expenses do we need to consider when comparing it with rent?
I'm sorry, what, other than your mortgage
Other than
payment?
the loan what you take, right? Other than the down payment, other than the loan, what other expenses will be there compared to renting when you own a house? What
Okay,
other
so recurring expenses on a monthly basis, right?
right.
Okay, so from a qualifying standpoint, we base your total monthly housing expense on your mortgage payment, which includes both principal and interest, as well as property taxes, homeowners insurance, HOA dues, if you are in a community that charges the homeowners association dues, and in many cases with smaller down payments, there's also a mortgage insurance fee. That would be if you're putting down less than 20%. So PITI is what we refer to: principal, interest, taxes, insurance, plus HOA and PMI if applicable.
So usually what will be the property tax? Is it like on a percentage when we buy a home?
Yes, in general, you can use 1.25% of the purchase price as a rule of thumb. You'll get a very close number in most areas. When you go out in the Central Valley near Tracy, it's more. But in most areas around here, it is around 1.25%.
Okay, so does it going to vary when the value of the house increase, or right? Does it going to vary?
So there's this tax proposition that happened in the mid-70s called Proposition 13, which really limits how much your property taxes can change. Your taxes can only go up basically at the consumer price index rate. So as the cost of living increases, your property taxes also increase, but it's predictable and measurable. You don't have to worry about your property taxes jumping way up on you unless you sell half of your house or change the ownership structure in your house, because that's what triggers the reassessment.
Okay, thank you.
You bet.
Dan, there was a question. Can you hear me, Dan?
Yes, I can hear you.
There was a question, is the tax benefit for renter, is it state, the benefit is state or federal?
This is all based on federal. There is a small tax credit available to some renters in the state of California, but I'm pretty sure that if you're buying a home in the $1 million range, that your income would be too high to qualify for that. But I should defer. That I'm pretty good at doing loans. I've been doing this since 1989. So I've seen a few ebbs and flows in the mortgage industry, and I can tell you lots about it. But what I can't do is tell you anything about taxes. You got to get that advice from a tax pro.
Hey, I have one question. So you're talking about owning versus renting, right? So that depends on the kind of price of the house that you're buying. How do you judge what would be the, like based on affordability and your income and everything, how do you judge what kind of house price to go for?
What you can qualify for?
Yeah.
Well, there's lots of factors to take into consideration. You know, there's the size of your household. There's, you know, the amount of dollars that are left over after everything that needs to be paid for is paid. So taking into consideration your food bill that wouldn't show up on our documents, or your utility expenses, those don't show up when you're qualifying for a loan. Those are all things that are practical for the homeowner to consider. But to give you the rough, how do you qualify? If you take your gross pre-tax income and break it into a monthly figure, and then take 43% of that amount, your total outflow of cash for your housing expense and any other payments that would appear on a credit report. So your house payment, which includes principal, interest, taxes, and insurance, plus PMI and homeowners association dues if applicable, plus any minimum payments on credit cards that would show up on a credit report, plus any car payments or installment loans that are due, student loans, things like that. You add the total outflow of cash on a monthly basis, add that to your mortgage payment, and that total should not exceed 43% of your gross monthly income.
Okay, and that doesn't include the full payment on the credit card, just the minimum effectively.
Right. Yeah. So if you owe $2,000, it's probably $40 a month or something. You know, it's a small number compared to your balance.
Yeah. Okay. Thank you.
You're welcome.
Hey, I have a question. So like, how a lender, because there are some banks who offer a rate, and there are different types of interest rates which are offered. So some people say that you have to go only with banks, and with the private lenders also they offer good rates. So how do you choose?
Well,
For a buyer, for buyer.
so I have 7 children, so you got to choose me. No, I'm just kidding. I'll tell you the main differences between lenders. There are 3 primary different types of lenders that are available to go get a loan. There are banks, and the quote big banks are B of A, Citi, Wells Fargo, Chase, and a couple others. Those are the big ones though, right? And they have a varying appetite for mortgages. In some cases, they don't want to grow their portfolio. They just want to keep their customers. So they're very aggressive at keeping their current customers happy. In other cases, they get very aggressive and start offering rates that are way better than anybody else can offer because that's their short-term mission. In the environment that we have right now, most of the big banks have very, very aggressive interest rates if you deposit a lot of money with them. So if you have an extra $250,000 and you put it on deposit with them, they very often are going to be better than I could offer you. They also, in some cases, will drop their price to rock bottom in order to be able to solicit you for everything else. Everything else being your car loans, your credit cards, your deposits, your insurance, your, cross-sell you with everything else. So it really depends on what their strategy is at any given time. In many cases, they're not interested in growing. And so their rates are not that attractive, right? It varies. So there's the big banks, and they should always be considered because sometimes they're really sharp. Then there are mortgage bankers. That's we are a mortgage banker. Need Capital is a mortgage banker. Our corporate offices are in Colorado. We have a relationship with Fannie Mae and Freddie Mac and a lot of other jumbo investors that purchase closed loans. And that's all we do is mortgages. So our motivation is to develop and nurture the relationships that we have with the investment community that invests in mortgage-backed securities. And so that we can provide, exemplary service at very competitive rates. And that's what we are trying to do at all times, is improve our pricing, improve our services, because all we do is mortgages. So you would hope by focusing on one area that we get pretty good at it. And I think we are. The last of the three options is a mortgage broker. A mortgage broker doesn't have any money. They just have relationships with different lenders that they can package up an application and send that application to a variety of different lenders that will then review it and approve it and close it if they choose to. The advantage of a broker is that they can shop the world and find the most competitively priced loans and ship your package off to them. The disadvantage of a mortgage broker is, for example, if you start down the path with one particular product and you get to the end and that particular lender that they ship the package off to doesn't want to do your loan, you really have to start over, and very often requiring a second appraisal fee and other expenses and time. You can't just change directions and move forward. You actually have to go backwards and start over. So that's a potential shortcoming of the broker environment. But I hope that answered your question.
Yeah, thank you.
Hello, Dan. I have a question. So how do you choose between a mortgage loan with points and without points?
Good question. So your interest rate, think of it this way. There's a price tag for a loan with a particular interest rate. And the price tag goes up the lower that the interest rate on that loan is, right? So if you want to get a really, really, really low interest rate, you typically have to buy that interest rate by paying points in order to get a lower rate. So the factors to consider in doing so are what is the actual cost that you have to pay in order to buy your interest rate down to a certain point, and then do the math. The way that it works with our products is if we lock a client in, let's say we lock in a 30-year fixed rate loan at 0 points at 3%. And we look at the pricing at 2.875 and it costs a half a point, or 2.75 or a quarter of a percent lower costs 1 point. So how long does it take for you to earn back your 1 point? 1 point, by the way, is 1% of your loan amount. At 2 3/4, if you pay 1 point versus 3% where you pay none. Using that formula of 1/8 of a percent is equal to a half a point, or a quarter of a percent is equal to 1 point. Your break even, if you go dollar for dollar, is 58.5 months on any loan. So round it off to 5 years, dollar for dollar. Now, if you do it a little bit more in depth in your analysis, for example, let's say your loan amount is 100,000 and you paid 1 point, that's a $1,000 expense. And you got an interest rate that was a quarter% below the 0 point cost. You are comparing a loan that costs $1,000 more to get. So if you borrowed 1,000 more in order to pay for that 1,000, then your break even pushes out beyond 10 years. But if you do dollar for dollar, in other words, $100,000 loan at 0 points versus $100,000, and you pay that $1,000 upfront out of your pocket, your break even is 58.5 months. So generally speaking, if you know that you're going to have your loan for longer than 5 years, or if the formula that I just explained to you isn't just like that, because in some cases you can buy your interest rate down for less than 1 point for a quarter of a percent in rate. If you can break even in less than 5 years, it's something to consider. And that's actually going on right now, where the rate at 2.5% on a conforming loan is not that much more expensive than a rate at 2 7/8 or 3%. So I've been doing a lot of 30-year fixed rate loans at 2.5% because it's a sweet spot for a lot of my clients. Hope that helps.
Okay, thank you.
I have a question. Would you recommend doing a loan of 30 years versus the 15 years and get that money in your pocket so that you can invest it, or rather do a 15-year and pay off the mortgage or the principal?
So I think it really depends on your circumstances. If you have children in school and need to have flexibility with your monthly cash flow, then a 30-year loan and you investing the difference into something that's going to grow, and then not have to do that every month. If you need to buy books and uniforms, then that flexibility is definitely worth something. And your overall net worth will be higher in the end if you are investing. But I think we all would like to be debt free. So having a low cost 15-year fixed rate loan and the idea that you can double up or triple up on payments whenever you can and pay your debt off, oh, that's freedom. If you don't have debt, it's freedom, right? So I think it really just depends on your family's circumstances and what is most important to you.
Thank you.
You bet.
I had another question. How long does it typically take to close the loan?
A purchase transaction right now, we can routinely close in 30 days or less. That's normal. I mean, we can close in 15 to 20 days in a market where interest rates are not so low. And we're super busy right now on refinance transactions. We're closer to 60 days. We prioritize purchase transactions though, but it's taking 6 to 8 weeks to close a refinance right now. And that's just simply because the capacity in our industry is at its max.
Okay, thanks.
You bet.
Okay, seems like, it's,
Uh,
go ahead.
One is the property tax also included as part of the loan?
That's your choice. You can set up an impound account. That's what it's called, where your property taxes and insurance are collected in advance and then paid when they come due. And if you do that, lenders actually like to have impound accounts set up because they know that the asset to which their loan is secured is insured and that the property taxes are being paid in a timely manner. So it's up to you, though. Unless you put down less than 10%, if you put down less than 10%, you don't have a choice. You have to establish an account like that. But if you're putting down 10% or more, it's up to you.
But the property tax, is it fixed per year or does it change?
It changes a little bit, not too much. It is predictable. But your lender will adjust your payment a little bit as the property taxes change. It typically goes up by about the inflation rate or the cost of living, the CPI.
Okay, thank you.
Mm-hmm.
Early on in your presentation, did you say that the property tax is tax deductible?
Property taxes are tax deductible, yes.
Okay.
Interest is tax deductible up to the interest on 750K. Loan amounts above 750K, the interest above 750 is no longer deductible.
Okay. Why would the renters and the buyers tax benefit differ? Because the renter is not affected by it, right? It's the owner will be getting that benefit. So at the time of buying the property, do you specify this is for rent or this is for personal use?
So you mean if you're buying a house to rent out to somebody else or buying it for your primary residence? Is that what you're
right
wondering?
Yes.
So if you are buying an investment property,
Mm-hmm.
The accounting for that from a tax perspective is handled in a totally different way from your primary residence. When you buy an investment property, it's a business essentially. And so your business expenses are deductible, which includes your taxes and your insurance and your maintenance and anything you do on it. You're going to deduct that from the income that you generate from that same property. And that is all documented on a form Schedule E on your tax returns. Whereas the interest that you pay on your primary residence and the property taxes you pay on a primary residence, that is all documented on your Schedule A, your itemized deductions.
Okay. So other than the loan, the additional expenses of buying a house are property tax and
well, homeowners insurance.
Insurance, right? The hard insurance. Right?
Yeah, that's for a typical single family residence, normal residential property, say 2,000 square feet, 4-bedroom, 2-bath, something like that. Your hazard insurance premium should be under $1,000, depending on what coverages you choose to have. That is definitely not the case if you decide to buy in the woods, up in the mountains, because of the fires over the past few years. Insurance in fire-prone areas is much, much, much more expensive.
Is the hazard optional or mandatory?
The insurance?
Yes.
It's
hazard insurance.
mandatory. If you pay cash for it, you don't have to get it. But if you have a loan on it, the lender requires that you have it.
Okay.
But I would highly advise it.
Also, like people say that when you go for townhomes, you have to pay more of other taxes rather than single family home because it's a community and you have to pay the extra maintenance charges. Is it so like that?
Yeah, what you're referring to are the HOA dues or the homeowners association dues. And so homeowners association dues typically cover things that you would have paid for anyway. Things like possibly your water bill, possibly your garbage bill, possibly your gardening maintenance of the outside of your place. That would include parking lots and mailboxes and all the common area maintenance. And if you owned a home, you would be paying for that stuff on your own anyway. It's just not broken into your monthly payment. So it is true that if you know, I'm doing a loan right now in a high-rise condominium in San Francisco. It's about a $2 million condo, and the HOA dues are $1,350 a month. Wow. But and for that they get to use a gymnasium that is closed because of COVID. But it's typically not that expensive. Most homeowners association dues, if it's just paying for common area maintenance and there aren't any extravagant features like workout rooms and gyms and things like that, they're typically somewhere between $250 and $400 per month.
So if someone buys a house that's like a duplex and they rent out half of it, can they get the lower interest rate, or it'll be like an investor rate?
So units are typically slightly higher cost in interest rate. There's a little bit more expense. And I think that's just to take into consideration the added risk of having multiple families living there, risk in terms of damage potentially from tenants, et cetera. I'm not really sure why the cost is different, but it's not much different. It's almost the same, unless it's all going to be rented out. The cost for a investment property from an interest rate perspective is typically about 0.5% higher than it is for a primary residence.
Okay, and you can get the same like 20% down loan as a like person staying in the house. What is that called? Homeowners rate for the other one also.
It's for a duplex?
Yeah.
Yeah, for a duplex for sure. For a triplex or a fourplex, in many cases, it's hard to convince a lender that you're really going to live in a fourplex in one of those 4 units. But in duplexes, it's very common. So yeah, we do that all the time.
Okay, thanks.
Could you throw some insights on the cost of refinancing, just to understand that when does it make sense for somebody to refinance? Say, for example, today I'm paying 3% interest, and tomorrow I know that it's become 2.8. Does it make sense for me to refinance?
Typically, for an 0.8% in interest rate benefit, it would not make sense to refinance. But what really needs to be considered is there's no general rule of thumb. I've heard people say that it needs to be, 1% lower, or otherwise it doesn't make sense. But that's not really true. What really is true is if you are lowering your rate and payment and it is not costing you a lot, it probably makes sense. So let me add a little bit more on the cost. The cost is, of course, dependent upon the loan amount, but let me just shoot from the hip with a rough scenario. Let's say you owe $700,000 and you are at 3.5%. And we could lower your rate from 3.5 to 2.5. if your loan amount was 700,000 and your rate was going from 3.5 to 2.5, that would be $7,000 a year in interest approximately that you would save. 1% in interest rate over a full year would be $7,000. So if you divide that into 12 months, it's like $600 per month plus that you're going to be saving. Now, if it's costing you $10,000 to save $7,000, you're going to break even in 1.5 years. That probably makes sense if you're going to stay there long term. Or in many cases in the past, we've done a lot of no cost loans. Now, let me clarify what no cost means. The raw one-time expenses to refinance or to get a loan for $700,000 are probably between $3,000 and $3,500. Those are raw one-time costs. So if I can structure your loan where we have 0 points being charged and we are giving you a credit of 0.5% of your loan amount, that would be a $3,500 credit. So in theory, if I can lower your interest rate, I don't have to lower it a full percent. I can lower it just a little bit. And if it's saving you $100 a month, well, that's $1,200 a year. That's more than you can shake a stick at. I'm not sure if it makes sense in your case, but $100 is $100, right? So if we could do a no cost loan for you and lower your payment, it's probably something to consider. But in part of that consideration is if you have a 30-year loan and you refinance every 2 years, after 10 years, you still have a 30-year loan. And that's probably not a good thing to keep going back to 30 and starting over. That being said, you can do the math and figure out where your sweet spot is and as to whether or not it makes sense.
Okay, thank you.
You bet.
So did you say that if you refinance, you can change the number of years again?
I'm sorry, say that again.
No, if you do a refinance, usually it's to reduce your interest rate.
Right.
But the number of years also can be changed?
Well, the common terms for loans are 30-year, 15-year, and in some cases less than 15 years. But those are the most common terms. So if you do a 30-year loan and then in 3 years do another 30-year loan, you're back to 30 years, right? But we do have the ability for you to do a 30-year or a 25-year or a 20-year or 15 or a 10 fully amortized loans for all of those periods. The benefit in interest rate is really you get a lower interest rate at 15. The interest rate is very similar at 20, 25, or 30. It's almost the same.
Okay.
So what are the downsides of choosing the lowest cost lender, the lowest interest rate?
What is the downside?
Yeah. Is there any risk?
Well, I don't know. Aruna could probably shed some light on this. If you get online and you search and search and search to try to find the lowest cost mortgage company, you'll probably find somebody that's willing to work for almost nothing. But usually what you get out of somebody that's willing to work for nothing is lower than acceptable levels of service. I can't say that for sure, but if you're going for the super discount, you're typically dealing with a kind of a fly-by-night organization in many cases. You could compare it in as an example to retail. I mean, if you go into Walmart, you're going to get a different level of service than if you go into Nordstrom's. and you pay for it if you go into Nordstrom's. So if you're cool with Walmart, that might be taking way longer than it should have, and it might be false promises that aren't delivered on time, or things like that. So I would say that price, of course, is very important, but it's not the only factor that should be considered.
Okay.
I have one question. So if I have a plan to close out my loan as early as I can, is that good to go with the ARM? And if I'm going with the ARM, is that anything I need to know about the difference?
So an ARM, just for everybody's clarification, is an adjustable rate mortgage, ARM. They do not work the same way as a fixed rate loan. They will adjust periodically, and there are a zillion different kinds of adjustable rate mortgages. The most common that you will see advertised are those that are fixed for 5 years and then they turn into an adjustable, or those that are fixed for 7 or 10 years and then they change. And if that rate over that 5-year period of time is substantially lower than what is available on a 30-year fixed rate loan, and you're pretty comfortable with knowing that you're going to be out of that loan because you're going to sell and move on, or you're going to pay the loan off for some other reason, if you're pretty confident of that, then you can save some money in most markets. Right now, in our pricing, our 5-1, 7-1, 10-1 pricing is worse than our 30-year fixed. That's an anomaly. That's not normal. But I haven't done an ARM in 6 months. We've done all fixed rate loans just because the benefit is not there in the shorter term loans as it is in most markets. Right now, there's an inversion in yields for some reason. And let me shed a little bit of light on one other area, and that is COVID. And this is just kind of general. When COVID became a reality and our economy got shut down, we had some wild gyrations in the pricing. Our interest rates went down super far really fast, and then the bottom fell out of the market. So remember I was explaining to you that loans get sold to Fannie Mae and Freddie Mac, and that's where everybody gets their money. Well, other than Fannie Mae and Freddie Mac, everybody else dried up. There was no market for anybody to sell loans. So all lenders that had loans in the jumbo or non-conforming arena suddenly had nobody to sell their loans to. And we had a huge sector of the mortgage market disappear overnight. And that sector of the market was what was referred to as non-QM, or non-qualified mortgage sector. And that was a type of loan product that we had available that would meet the needs of people's financing scenario that was maybe a little bit outside the box. An example would be somebody that has great credit, a huge amount of cash in the bank, but is in a field that they only get paid every couple years, like venture capital or commercial real estate, or some type of field where they get big checks, but not regular checks. Well, we had loans that we could base the qualifying on your cash reserves by doing a factor of liquidation. If you have a lot of money and we divide it by 360, how many payments do you have saved up? And it was called an asset depletion loan. Those went away completely. Loans where the overall debt as a percentage of your gross monthly income was higher than a certain point, went away completely. That's why I said the max that we could do is up to 43% of your gross monthly income. On all of our jumbo loans, it's 43%. Before this implosion, we could go to 50% with a lot of our non-QM loans. So it really changed what is available. It also changed the market for buyers because everybody learned how to work from home. As you guys all know, traffic patterns are very different now than they were 6 months ago or before 6 months ago. And they're outlying areas like Hollister and San Juan Bautista and, Gilroy, and even just up in the hills all around here that are much longer commute distance to their regular place of work are now very much doable in terms of acquiring those properties because they can work home most of the time. And that has changed the market substantially in outlying areas where the demand for good properties in areas that would normally be considered an unacceptable commute, Dublin, Livermore, Pleasanton, those areas have gone crazy with appreciation or demand. And it's had an interesting impact. And what it's really doing is it's providing, I think we'll see how it works out. It's providing more inventory, we hope, where home buyers will have an opportunity to go look and see a house and maybe think about it overnight before they have to write an offer. I don't want to step on your toes, Aruna. You can shed light on that.
No, that's fine. I do see that same thing. I'm showing more homes in Dublin and Livermore and Morgan Yale too.
Yeah, it's really interesting how that's happening. But if you happen to be in an industry that is impacted adversely by COVID, industries like the restaurant industry, it's really difficult to get you a loan in an environment like this. And also, I don't know if there's any homeowners in this group, but one of the things that came about when we went into COVID environment is lenders offering forbearance. And what that means is a lender is telling their customers that if they have a financial hardship, they don't need to make mortgage payments for a while until they can get back on their feet financially. And during this period of time, it's a agreed upon forbearance that won't destroy your credit history. And that's true. It won't destroy your credit history, provided it's organized and approved in advance. However, you can't get a loan if you're in forbearance. You can't refinance if you're in forbearance. You can't buy another home if you have a loan that's in forbearance. You have to repay everything and make sure that everything is all caught back up and no deferred payments or interest exist. And then your credit status is fully recovered. And a lot of people didn't understand that. A lot of people thought, oh, great, I don't have to make payments for a few months. Let's just stop making payments. And then they want to refinance because interest rates are so low and go, oh, you gotta pay $20,000 toward your loan first. It's been interesting. Any other questions?
Sounds good. I think we're just about time to,
Okay, so I want to just offer to anybody, if you would like me to work up this rent to own worksheet for your exact circumstances, I'd be happy to do that. Can I give you everybody my phone number?
Yes, please.
Okay, my cell phone number is 408-857-9944. And just give me a call or text me whenever you get a chance.
Yeah, thank you, Dan, for joining us today. That was great.
You're welcome. You guys all have Aruna's phone number too, right?
Could you please repeat that?
My phone number?
Yes, please.
Okay, yes, my phone number is area code 408-857-9944. And my name again is Dan Detar, and the last name is spelled D-E-T as in Thomas, A-R. If you want to peruse my website, it's really, really easy to remember. It's dandetar.com.
Awesome. Thank you so much.
You're welcome. Thank you.
Thank you, everybody.
I enjoyed this, guys. I wish you all luck and hope to hear from you someday. Thanks,
Thank you.
Aruna.
Thank you. Thank you,
Thank you.
Dan. Okay,
You're
bye.
welcome.
Bye,
Take
everybody.
care, everybody. See ya.